Hi, Chris Camburn here with 1406 Financial, where our tagline is investing at your pace. And man, starting off 2022, is it ever a time to make sure that your investments are aligned with your risk tolerances and you're investing at your pace and not someone else's, trying to keep up with what occurred in 2021. So the reason in this video today, I'll go through some performance for the S&P from last year and this year, some research on data for how the market has performed in various environments, and the goal is to give you some confidence that there will be a positive outcome from this, and also some ideas for how to handle your savings and investments now and at any time. So let's get into things. Through the website, spglobal.com, S&P puts together the S&P 500 index, which is probably the most widely used index for knowing how the stock market is doing. It used to be the Dow Jones, but now I'd say it's more the S&P. And if we look at what's going on here, year to date, the S&P is down 9.22%. So clearly a tough start to the year. However, let's remind ourselves what happened last year, or what's happened in the past 12 months, I should say, because this is a 12-month number. 15.35% if you started investing a year ago. Now, look, I recognize any money we've put to work or you've put to work this year may be down, but I also want to remind you that the longer monies are invested, the better chance they have of a successful outcome using the S&P as a benchmark. So for the past 1 year, again, the S&P returns are up 15.35. And let's go out to 3 years. And this is an annualized return, so it's averaged 17.53% for 3 years. And you know the routine, it just gets better. 5 years, it's averaged 13.52, and for 10 years, 12.64. Now, past performance is no guarantee of future results. You know how the saying goes. But let's look at the time. Let's look how time impacts portfolios. And so I know there's some great research from J.P. Morgan, whereby if you Google J.P. Morgan Guide to the Markets, you can click on their Guide to the Markets. And this is their Guide to the Market as of December 31st, 2021. I think there's some pretty cool stats in here. If I may, I'm going to open this up in Adobe, just because for me it's a little bit easier to navigate here for the presentation. And I'm just going to cherry pick some slides. You can look at all the slides, but I'll only pick out some slides that I think would be really helpful for what we're going through right now. What we're seeing here is annual returns and intra-year declines. What this chart shows is in given years, how bad it may have gotten in the year, and then how the year ultimately ended up on a calendar basis. Now, this data from J.P. Morgan, again, returns are based on the price index and do not include dividends. Intra-year drops refer to the largest market drops from peak to trough during the year. Okay, so the largest drop from peak to trough during the year, it's for illustrative purposes only, right? So it's no prediction of what might occur. And returns shown are calendar year returns from 1980 to 2021, over which time period the average annual return was 9.4%. All right, so returns are calendar year returns from 1980 to 2021, calendar year. So for the calendar year 1980, the biggest, from high to low within the year, the market dropped 17%. In 1981, at some point, the market dropped 18% within the year, and it ended up the year down 10%. So you can go through that. But what's interesting to note is that as many times as the market had a big decline throughout the year, look how many times the year ended up positive. So despite average intra-year drops of 14%, annual returns were positive in 32 out of 42 years. So that's quite interesting. So even when you see these big drops throughout the year, generally my suggestion is to stick with it as long as you've set yourself up properly to begin with. And what I mean by that, I'll get into in a little bit here with some information I've put together. But that's pretty interesting. As much as the market may drop within a year, 32 out of 42 years have been positive from 1980 to 2021. Another page from this slide discusses time, diversification, and volatility of returns. And let's look at some of the disclaimers. I love the disclaimers on these slides. Let's get into it. Let's see all the fine print to really know what they're talking about. Returns shown are based on calendar year returns from 1950 to 2021. All right, so 71 years of calendar year returns. All right, it's January 1st to December 31st. There's something else called rolling 12 months, rolling 3 years. And a rolling period would be like, a rolling 1 year is is like March of 1982 to March of 1983. Or a rolling 5-year period could be June of 1990 to June of 1995. That's a rolling 5-year, but these are calendar years. This is a January to December results. Stocks here are shown using the SP 500 Shiller Composite, and bonds represent Strategist Ibbotson for the periods 1950 to 2010, but the Bloomberg aggregate thereafter. Let's just assume there's similar total bond market indices, and growth of $100,000 is based on annual average returns from 1950 to 2021. All right, so we're using a broad market index and broad bond index. And what this is showing us is the range of stock, bond, and blended total returns over this period, 1950 to 2021. And so what this indicates is that the range of stocks within some calendar year over those 71 years, stocks at for 1 year, the worst returns ever, down 39%. And the best during that period, they were up 47%. Bonds, best year in that period, they were positive 43%. And the worst year for that period, negative 8%. And if you look at a blended portfolio, 50% bonds, 50% stocks, the best year was a positive 33%, and the worst year was a negative 15%. Now, one thing, I tried to do some independent research to figure out what year bonds may have been up 43%. I can't verify this number, but I have to if we just take JP Morgan research, face value here, and presume that they've done a lot of diligence in presenting this report, that's a pretty big positive year. But the point of this is going to be that as time goes on, the swells, the extremes are reduced. So for instance, over a 5-year rolling period, so that would be 1950 to 1955, 1951 to 1956, et cetera, 2016 through 2021, the best annual return for the rolling 5-year periods would have been an average of 28%. And the worst, look at that, the worst 5 rolling years for stocks was down 3%. So if the worst 1 year was down 39, but after 3 years, the worst average return was negative 3, clearly time helps as you're trying to invest and you're trying to grow your portfolio and your savings and investments. Let's just clear the slide here. For that period, the best annualized returns were 23% over 5 years for bonds, negative 2 for bonds over that time, and blended portfolio 21 and 1. Going out to 10 years, the worst average annual returns for 10 years would have been down negative 1. Now, negative 1 annualized for 10 years means it was a total return of negative 10 cumulatively for 10 years. And the average for rolling 10-year periods has been a positive 19% on stocks. Bonds have not had a negative 10-year rolling period during this period of time, and nor has a balanced portfolio. Interestingly enough, bonds and balanced are both shown at 16 here. Going out long enough, holding on to stocks, holding on to bonds, or holding on to a blended portfolio has provided positive returns over every rolling 20-year period. Now, just to note here, that's not a fun stat the older we get, right? Not all of us are investing for 20 years anymore, but I'll talk about how to mitigate that in a moment. But for long-term investors, 10, 20 years plus, if you don't need your money today and you are investing to make withdrawals in 10 or 20 years, as long as you have a good approach to what you're doing and a diversified portfolio, chances are you'll recover from what we're going through now, and chances are you'll have more money in the future. Then your portfolio will be worth more in the future than it is today. I just playing the statistics. So when I say as long as your portfolio is set up properly, let's look at what I suggest people do at any point in time, whether you're telling me today, last year, last week, or whenever. This is how I suggest that you establish your portfolio to ride through almost any market environment. So some basics. I try to share with people that there's three basic investment categories. And the and is there's an X factor out there. There are growth investments, which are generally equities and stocks. You can own these directly in mutual funds, index funds, ETFs, or inside annuities. There are income investments, and these are generally fixed income investments in bonds, which you can own directly in mutual funds, index funds, ETFs, and annuities. All I had to do was hit that. There are preservation of principal investments, which are generally fixed income in bonds. Again, you can own these through direct ownership. That means buying them just by themselves, or you can use a mutual fund, an index fund, an ETF, or annuities to buy these. And then the X factor is cash, which is bank account and money market funds. Now, something to know, let me tell you, if you buy an investment product whose investment objective is growth, if it happens to provide you with income, or if it happens to be stable for some amount of time and preserve your principal, that's just a coincidence. If you buy an investment whose prospectus or whose mandate is growth, it's going to try to achieve growth. Also, if you buy an investment whose objective is income, if the principal happens to grow, that is an unintended consequence, or it's not by design. Let me just tell you, growth investments are designed to grow. Income investments are designed for income. And capital preservation, it happens to grow, or if it happens to pay you income, it's just a byproduct of the environment at that time. But just understand, don't expect income investments to grow. Don't expect growth investments to pay income. Just letting you know ahead of time so that there's no confusion for how these things unfold out there. So that being the case, chances are you're probably aware that the greater the potential returns of an investment, the greater the risk is. And potential risk means risk to your principal in this case. So as you try and achieve greater returns, you're also going to have to assume greater risk. So on the spectrum of this, growth investments are out here. They're the most risk to principal, but they're also going for the greatest level of growth. Income would be somewhere around here, because as you're seeking income, your principal will also fluctuate. Preservation of principal is coming down into the safer zone. There won't be as much risk with your investment, and it's also not going to give you a lot of returns. And I would put cash at the bottom of this spectrum matrix here. Cash, historically, yes, it has had some rate of return, but where we are now, it's not paying anything, but it's also not going to lose you money if it's FDIC insured in a bank account. And also money market funds are pretty conservative. designed to preserve your principal. So when you set up your portfolio, if we go for the classic case here. So in designing a portfolio, here's what I suggest people do. Now, in our world, there's this thing called asset allocation, and that's the percent of your money in the various categories of investments. Percent of cash, percent of preservation of principal, income and growth. And there's a lot of stats out there and a lot of research for what is the optimal amount to have in all of these. But I'm going to change the script here, flip the script. It's not about what they say. This is investing at your pace. This is about you. And so what I suggest people do, and this is the way I would ask you to position your portfolio, give this some thought. I want you to think in dollar terms. So how many dollars am I willing to have in growth investments, income investments, preservation of principal cash? If you're a conservative person, I would ask you to consider, to ask yourself, how many dollars do I need not invested so that I'm comfortable with the amount of dollars that I do have investment? Just assume $1 million portfolio at this point. To go for the most growth, also the most risk. I mean, you want all growth investments to get the best possible long-term returns. But what becomes very difficult is when you get closer to needing your money and you're worried that you don't want your investments to drop by a certain amount. So what I suggest you do is let's consider how many dollars do you need in cash or preservation of principal investments so that you're comfortable and you can ride through it. Maybe your answer is no, none, Chris. I'm fine. I want all my money growing at the highest potential rate. Well, that's fine. But let me tell you, quite often the person will say to me, Chris, hey, listen, I want to make sure I have 50,000, 100,000, 200,000. I want half of my money, $500,000, in investments that are not going to decline precipitously or are geared to preserve my principal. I don't care what I make. I just don't want to lose. I mean, I have this saying that the remorse of loss is greater than the reward of gain. So, I mean, you can walk around all day like, oh, I had $500,000 and now it's at $400,000. That hurts more than the reward of $500,000 increasing to $600,000. So I would encourage you to think, how many dollars do you need in conservative investments? And once you have that number, then we'll backfill for, well, how much do you want to try and generate income, and how many dollars would you like trying to achieve growth? Which will ultimately allow you to benefit, should these historical stats of stocks and bonds come to fruition. If you have a portfolio that you can live with, you'll have a better chance of receiving these outcomes going forward. Excuse me, one sec, I have a call. Well, hopefully there at the end, prior to getting that call, I was able to sum things up for you. I just really think it's important, no matter what the market environment, whether we're going through a market like now, or whether there's been smooth sailing for years, I do think it's really helpful to have the proper mix of growth, income, preservation of principal, and cash. Just the proper mix for you will help you navigate the markets, have confidence in their overall results, and stick with the game plan for enough years that it hopefully works out successfully for you. In addition to what I showed on the screen today, I offer a free guide to financial planning. It's a guide where I'm trying to tell you all the stuff I've learned over 20 years. I'm just trying to give you some facts and some information on a free guide. You can click. There's a link in the description below, or a link in the description below. You can click to receive the guide. It's the Guide to Financial Planning. Most recently, it's from 2021. And as soon as I'm able to update it for 2022, we'll have another one out there. But hopefully this video was helpful. I wish you the best. And overall, this doesn't have to be complicated. Just come up with a game plan and allow yourself to stick with it. Thanks for watching.